Welcome to the CFO Hive podcast. Bijan, thanks for joining us. How you doing?
I'm great, David. Thanks for having me.
Yeah, pleasure. Maybe just to kick off, share just a little bit about yourself for the audience.
My background, I would say kind of the traditional accounting roots, starting at one of the big four accounting firms and kind of moving my way through my career. I would say I kind of wear two big hats at the firm at M&P right now. So at M&P, I'm the national leader for our accounting advisory group. And so think of that as like consulting for accountants, right? So, we've got clients that get through difficult situations and we just kind of help them navigate through that. It's like acquisitions, going public, they need to do a conversion of gaps from like ASPE to IFRS, like these kind of big activities, we help them navigate through that process. So that would be kind of my first hat. And my second hat would be the traditional public company audit. And what I would say at M&P, we really work with these emerging companies, so very high growth companies. So a lot of companies that are looking to go public, that are going public, but are in that like heavy acquisition, raising money stage. So very exciting.
Yeah, very cool. Very cool. And did you started out in audit? Which firm were you at? Was it Deloitte?
Yeah, like the traditional, you come out of university, you do your kind of articling at a big four accounting firm. Had a great experience and, eventually moved to M&P and I loved my experience at sort of the big four as well. But I think the big difference with M&P was, pretty quickly in my career, I was able to work with like the CFOs very early, right? It was, you're like in your like early to mid 20s and you're working with CFOs, audit committee, board members. That's a really good experience to have very early in your career. You just keep building and building on that over time.
Yeah, we've been having those conversations. Just recently had Larry Zeifman on the podcast, the last episode we put out. And one of the topics we're covering was, sort of big four experience versus the mid-market firms and just the type of exposure you get just to the broader, I think just what you're speaking to now. You wouldn't trade the big four experience because, there's a great foundation, but the experience you can get at some of the other firms, I think opens you up a little bit more to, IPO, M&A, meeting the owners, meeting the CEOs, meeting the boards at an earlier stage. Would you say for M&P that today it looks more like Big Four than the mid-market?
I wouldn't say we look more like Big Four. Certainly we are bigger than where we were when I started. That being said, what stayed the same is the type of clients that we serve, right? Like we don't do the Fortune 500 companies of the world. Right. We still do that real mid-market. And, as you know, David, like the mid-market in Canada is such a big part of the economy, right? Both on the private side and the go public side. We have a really big mid-market. So, I would say certain times Big Four have their sort of clientele that they go for. And M&P, we've got our kind of sweet spot. And it's a really good sweet spot to have, being like kind of that leader in that mid-market, which is so important to the Canadian economy. Yeah,
for sure. Is the practice, the accounting advisory services, right? Is that practice unique to M&P? Or what elements are unique? I'm sure they all have advisory of some sort, but what elements of it are unique?
I would say like most firms will have, like the bigger firms will have an accounting advisory practice in some way. I think how they're structured can be different from firm to firm. You could have one that is more like super technical in a sense that like, hey, it's a lot of like on the more technical side and really just helping clients there. What I aim for in our group is being a little bit more transactional. Really, it's not just about our team knowing the accounting standards. It's more about like navigating uncertainty and helping companies through their, first time audits, right? And really being that more of that advisor and not just knowing the technical rules, right? So, how I try to position our group is really on that, try to speak English, right? Accounting becomes like more complicated every day. Every year there's new accounting standards comes out. Seems like accountants speak one language, the other people in the business community, bankers, debt holders, like they just speak a different language. And part of the job is navigating through that complexity, but also trying to do it in a way that really resonates with all the parties, right?
Right, right. So just on the market side of things and where we're at, we were talking just before we pushed record on, how our falls are going so far. Where would you say things are in the market right now? Interest rates, obviously, there's been big announcements and maybe expectations of what's ahead. But yeah, what are you seeing in the market?
Mm-hmm. I mean, if I look back, David, if like a few years ago, like say like 2019 to like 2021 was very hot on the venture capital side here, like companies going public. We had a lot of crypto companies going public. We had a lot of cannabis companies going public. We had gaming companies going public. So there was a time where things were very, very hot. And then obviously it's sort of cooled down, right? Interest
Yeah.
rates went up, less government stimulus. So I'd say the last 2 years on the go public transaction side has definitely been slower. I don't think it's fully picked up yet on the venture side, but I think with the lower interest rates coming in, and we're hearing a lot more chatter, right? And I'm hoping in the next few months that really things start picking up. But yeah, I don't know what you've seen on your side, David. I haven't really seen it fully take off yet, but I'm optimistic that it's gonna start kicking in soon.
My expectation is things are going to pick up, and then it's going to be really kind of hard to keep up with the pace, but it's there's still some waiting. But things like go publics, I'm not hearing as many of those.
No,
Folks are still kind of struggling to raise capital, but I sense more optimism about the market.
for sure. And once you get some momentum, it just seems to like, a few people start doing it and then like, well, everyone wants to join in, right? So it's kind of like sometimes things just hit you very quickly,
Exactly.
but we'll see when that point happens.
Exactly. What kind of advice are you giving businesses today, factoring in where the market is at, and what are you finding business owners are really needing to hear from you as far as, how to approach the market?
So again, I guess more from the kind of angle, and this is just more my background on the go public side, is like, you want to be ready for when that day comes. You don't know when the market will take off, right? And if that ultimately is your intention to do an exit, or not an exit per se, but go through the go public route, it's not just going to happen overnight. So let's say if the markets kick off and you're like, okay, now I want to go public. It's like, well, do you have everything in order to do that, right? Because if you haven't started the process, honestly, it'll take over a year. If you know you want to get that route, are there certain things that you can do now to make your life easier through that process, right? And some very easy ones, I would say these days, probably one of the biggest hurdles. I would say the biggest hurdle is raising money. Like there's no denying that. So having that kind of avenue and channel kind of ready to go, or having those discussion of bankers and getting your story out there, I think is really important. And then the other side is kind of where we step in, is really on the regulatory side, right? So if you know that you're going to go through that route, it's always best to kind of have your audits done and ready to go, and just have them continue and just be ready for that moment where you're ready to pounce. Because I'm sure you've seen it, David, like there's a huge shortage of accountants out there. You don't feel it now when the economy is a little bit slower,
Yeah.
but I guarantee you when things get hot again, you're gonna feel that pinch, and you're not gonna be able to find your your accountant or your CPA that you want to work with, because they're gonna be so swamped. So now is the time to make those relationships with everyone when things are a little bit slower. Make a relationship with your lawyers, your bankers, your accountants, so that you're really ready to go when that time comes.
Because even at the outset here, when we're talking about our backgrounds, that's sort of not the traditional path that CPAs are taking today, coming
Mm-hmm.
from audit, which, amongst other things, has changed the world of audit today. The cost of audits have gone up. The firms are being more picky about
Mm-hmm.
who they take on because of limited capacity. And so that's an interesting point, that one of the lookouts there, if you do think you're going to go public in the next couple of years, get started now is what you're saying, right? And obviously you talk about developing relationships. Would you say getting the audit done itself makes sense, or the readiness for that? Like how far should you be going today down that path? I did really, like, maybe yesterday spoke to a company that, were asked to get an audit done from their lenders, and
Hmm.
it wasn't a significant amount, and so they felt a little bit uncomfortable, but they also knew that this was going to set them up for future needs, including the potential to go public. So yeah, where do you land on that? When should they start really getting an audit done?
Yeah. So,
Yeah,
I want to keep in mind, obviously, people, businesses also want to be cost conscious as well,
yeah,
right? So I know audits are not easy; they're expensive, and so you really need to look at, hey, what does your future look like, right? And if you do think there's a very good chance of that, it could be an IPO, but it could also be, hey, you're looking to be acquired by a larger player at some point, and at some point they will also want audited statements as well, right? And again, like, if you look at our accounting framework in Canada, you've got ASPE, which is for private companies. But IFRS is a lot more complicated, right? So you also want to be ready, hey, if you're going to go down that route, maybe you want to have your statements under IFRS as well. And if you're getting acquired by a US entity, or you think you will be, we're going to go public in the US, and maybe you also need US GAAP. So there's obviously a lot of considerations to make there. But let's say if David, if you want to go public, you come to me and be like, Bijan, I want to go public, ASAP, right? And I want to go public on the TSX Venture or the CSE. So, a junior exchange here in Canada. That's actually one great thing about Canada, that we do actually have those venture exchanges. That's not necessarily common in other countries like
yeah,
the
yeah,
US. They've got OTC markets, but they don't have the same sort of venture markets that Canada has. So, you come to me and say, hey, I want, to go public on the TSX Venture. What do I need to do? And I'll say, hey, you need to get if you want to go now, you're likely going to have to get 2022 audited, 2023 audited, and then all your quarters up to date as well. And then you'll say, well, we don't have anything ready for the last 2 years. So you got to go back in time and spend all this money to fix things that if you just did it right at the beginning, it would make your life a lot easier, right? It's very difficult sometimes to go back on certain transactions. It's hard for auditors to go back in time and do inventory counts if they weren't there. There's always workarounds, but it's going to cost a lot more money. So if you're going to go down that route, if you invest a little bit now, you can save more money in the long run. It's just difficult for people to make that decision in practice. People want to save their money now and use it when they really need it. So if you wait last minute, it can be done. It's just going to be a lot more expensive, right? And it's going to be way more of a headache.
yeah, yeah. I get it. It's hard to invest for something down the road.
Yeah, exactly. So you either pay now and you can get it at a good price, or you pay later and you've got to pay the premiums and all that to get yourself where you need to be.
How's the consideration around whether one should go public? How has that changed, and how does that look today when you're advising companies who might not know that they want to go public, but want to know should they be considering going public? How do you answer that?
Yeah, so I think, David, it's you kind of look at the pros and cons, right? It's not all pros. There's a lot of cons as well to go public. I think obviously pros is you've got more liquidity for your stock, right? You can do capital raises, you can raise more money. You can even you're on the venture exchange, you can use your shares as currency in some sense, right? You can use your shares to buy other companies. So I think the liquidity is a very big deal. And so that ability to raise money is all positive. But on the negative side, well, if you're like someone who has had full control of your business before, and you were like running the shots, and you were the CEO, founder, and you owned the majority of the shares, you're going to lose that control through that go public process, and you need to be comfortable with that. You might still stay as the CEO, but you're not going to be able to just do whatever you want in the same way, right? You got stakeholders, right? You got to report to your shareholders, any debt holders you have, of course, as well. You've got a board that's going to have that oversight. So you have to be comfortable with that definitely additional level of oversight. And it's a lot more expensive, right? It's not just about the problem a lot of clients have. It's just about going public, but then they don't realize that once they're public, it's like, well, you got to continue this going forward. This isn't like a one-time thing. At the end of the day, you go public and you have to do all the continuous disclosure requirements. You got to report quarterly statements. You got to get the audit every year. So there's a lot of ongoing costs as well.
Right.
I do say, like, if you want to go public, there should be some sort of plan. Is there like a big M&A plan that you're doing? Like, why do you want to go public? Why do you need to raise this money, right? So there's a lot of positive. And can you raise that money in the private market as well, right? I find in Canada, when you look at the venture space, it's a lot of, I would say, higher risk companies, in a sense that they're companies where it would be a little bit more difficult in those early stages to get lending from the bank, right? Because they don't
Right.
have a proven revenue model, or if they don't have a, they still need a lot more investment to get to where they need to be. So by definition, it's a little bit of a riskier market. But, sometimes a big risk comes big reward as well.
Yeah, no, super helpful. I think laying it out for people, it's uh, easy to look at it as, we need to get there because we need to raise capital, and then, we're sort of sailing off in the sunset. I think that's not the reality. You need to have, as you put it, a plan. I think that's really helpful for perspective and guidance, ongoing news flow.
Mm-hmm.
You don't just take the money, get into a room and kind of do what you want. You're now having to explain, what you're doing, and people are sort of real time looking at your performance and your results almost day to day. And some of that then becomes, you need to pay attention to the macro environment. It just completely changes how you need to think about your business and your stakeholders and how you're communicating.
For sure. And I think, David, that that constant communication, it's almost
Yeah.
like a full-time job just to manage. It's like,
Yep.
you sometimes companies have, like, hey, they have one individual that more manages the shareholders and the investors, and they have more like the president or COO who does more of the operational kind of part of the business, because it's very hard to do both. At the end of the day, your time is limited, and dealing with shareholders, dealing with your board, dealing with lawyers, and like you said, like, when you do significant activity, there's rules. You've got to press release certain things. So you just got to be on top of all those things, and that itself can be a full-time job.
So this is a good segue for the world of CFOs, which we've talked about in the past. Some companies need help in that regard. What do you see as the role of the CFO for the companies that tend to come to you, want to go through that kind of process, and may or may not have the right CFO? So give me a little bit of what you've seen in the market and what you advise companies in terms of what they should have in place to help them navigate.
Yeah. So, David, it is very common for, I would say, kind of the venture companies to have fractional CFOs. Like, they don't necessarily need that full-time CFO. So it's very common for, a fractional CFO to do a few of these venture type companies. Obviously, once you get to a certain stage, you need a full-time CFO, right? But there's a stage where, hey, especially in the resource space here in Canada, it's like, hey, you don't have enough activity to have that full-time CFO. So obviously, like, cash flow management is super important, right? The ability to, I guess, time the raising of money, helping the CEO, again, they're so busy with probably the business side of things. In my mind, that CFO really needs to be on top of the cash flow management, figuring out when they need to raise more money, so that you're not scrambling last minute to try to raise money within a month, or you're going to not be able to continue to operate. So cash flow management is super, super key. And obviously CFOs would have that experience, CPAs would have that experience. So very, very important to have that side of the business or financing covered. I would say as well, helping with the raising of debt and equity, and helping the CEO through that process. Obviously, a lot of the fractional CFOs who do a lot of, let's say, public companies, they would be more in tune with the type of capital raises that are done. Like, typically, in Canada, we've got share units that are issued, and the units would have warrants as well. And so they would be more in tune with what type of capital raises are available and how to raise that money, and working with the lawyers and bankers help navigate through that process. So for sure, with the fractional CFO, cash flow management, helping kind of raise capital as well. And then there is a big reporting need, like I mentioned before. One of the challenging parts of being a venture type company in Canada is that there's no easier accounting rules for being a venture company. Luckily, you've got longer deadlines. So typically, as a venture company, you would have 120 days to, release your audit opinion. You have more time to release certain filings. However, the accounting standards are technically the same. And I would argue that standards like IFRS were not designed for the venture type companies, right? A lot of what IFRS, in my opinion, was designed to do is for the larger type companies. So you're applying this difficult standard on companies that are in this heavy growth phase. And we all know, and you've probably dealt with this as well, David, like in that growth phase, you have to be very creative in terms of how you raise money, the types of transactions that you enter into. And all of these creative transactions have very complicated accounting implications, right? So the CFO does need to be on top of that, even if he's not the one doing all those things. Perhaps he has a controller helping him out, or if he has like a firm like an MNP that would help him through that process, he's still ultimately responsible, right? He's the one that's kind of signing off on the statement. So he does need to have a pulse on that. Some CFOs that we deal with are very good in reporting and kind of take that whole function for the venture type companies. Some deal, again, more on the capital raising side, budgeting side, and then they really outsource to some degree a lot of that reporting, but they're still ultimately responsible and need to understand it. So, there's many skills that you need for a fractional CFO. It's hard to have all of them, but where you don't have that skill, you need to know who to talk to, right?
Component. And then, I think understanding then how your advisory practice, for example, could be really helpful in working with, a controller and a CFO, or they just have the CFO without the controller. I had been a CFO where, there were, let's just say, more robust operations and commercial aspects, and the CFO role was spread across a lot of functions and responsibilities. And so the path to going public was like a completely different lane, getting the statements from ASPE to IFRS. I didn't even have that skill set. And so you need the right specialization. And so who you turn to, I think a really good controller to help you get those statements IFRS ready is important. But that even is not necessarily enough to navigate a whole process to go public. So help me understand how, coming to you, you might be able to help fill those gaps, whether there's a controller or not. How do you collaborate?
Mm-hmm. It's a great question, David. And firstly, like you mentioned, having that controller is very, very important, especially in a company that has a lot more transactions. At the end of the day, it's way more expensive to, again, try to do like the day-to-day entries after the fact. Like that has to be done correctly, right? So I think you need a good controller. You need to make sure you've got the right bank reconciliation. It's all these kind of key controller activities on the reporting side. They need to be done. In Canada, the most common way to go public is through a reverse takeover. Mm-hmm. It's actually, I think every single transaction I've done in Canada that's been a go public on the venture side has been a reverse takeover, right? So you usually will have an operating company that wants to go public. So that's one party. You'll have a shell company that's already public that you will use as the vehicle to go public. So those are two parties there. You've got your kind of investment bankers, you've got your lawyers, and then ultimately you've got your auditors as well, right? So obviously in a lot of situations, MNP would act as the auditor, but in cases where we're not, a team like ours could come in from an advisory perspective and help quarterback the whole process, right? And in a sense, that's like, hey, a lot of the times the problem is some of the auditors won't be able to speak with, like they're speaking different languages, right? Like the auditors want A and management's giving them B, and then they just keep kind of clashing and nothing is getting done. So a party like ours could come in the middle, speak to management, say like, hey, this is really what they want. Let's help you get there, and just speed up the process, right? And help get the lawyers what they need from the filing side, help get the investment bankers whatever they need from the modeling side. So a team like ours can really come in and just help coordinate the whole situation, help management prepare those memos and the technical analysis for the auditors, and just help kind of smoothing out the whole process, right? In the peak of the go public kind of time when there was go publics almost every day, one of the biggest bottlenecks were the financial statements. And it just came down to, the auditors are doing the best that they can, and everyone would blame the auditors. But it's like at the end of the day, they can't make the information. They're there to audit the information, so they can only help so much. So a team like ours would be more flexible to really help out management, because we wouldn't have the same independence rules like an auditor would have. But really quarterback the whole transaction and help just navigate and help with those technical analysis as well.
Yeah. You're giving me flashbacks, and not all good ones. But when you said you don't think IFRS is really designed for the venture companies in mind, or smaller companies, I would second that. I just remember feeling that the statements were harder to understand once we went to IFRS, and I almost wanted, a second set of books, one in ASPE, so I actually just knew what was going on.
Yeah.
And once you get into IFRS, the complexity goes up, note disclosures, and just even where things are placed and how they're presented could throw you for a loop.
For sure. And, there's a lot there. There's a lot of complications. And I guess maybe one piece of advice I would give to fractional CFOs, or one thing or an attitude I would see that's often not the correct way to approach it, right? So let's say if you're a venture type company, I totally understand the perspective. When you look at the financial statements, you'll say, hey, the investors don't really care about the numbers right now, right? Like, we have very little revenue. They just want to know how much debt we have and what our share capital situation right now, but they don't care about all these things, right? So then some people would take the attitudes like, hey, they don't really care, so let's just do something, let's get it through, and not accept the complexity, right? The problem is, even if theoretically that's true and your investors don't care about these things, the regulators do, right? And they can make your life very, very painful. So what I would say is, you're not always going to like these IFRS conclusions, but you do need to just accept that, hey, you do need to do it right, because you could get into a lot of trouble if you start trying to get out of it and trying to make shortcuts where you shouldn't be making shortcuts. So, just accept that, hey, there's certain complications that maybe don't make these financial statements as readable. Like, maybe, just think of ways of explaining it, or things you want to point out to investors, but you gotta be in line with the standard, and you can't get out of that, right? And at the end of the day, your regulators, your auditors, they're not going to buy any of those arguments. So you really need to keep that in mind, because you don't want to get in trouble with the regulators. So you want to do the right thing, even though the truth is some investors really don't care about some of that information. It is what it is.
Yeah. Bijan, for our CEOs, CFOs, and anybody that may be considering going public, what should they know about regulators? Who are they? And what do they need to know going in? How do you deal with it?
Yeah, so the biggest regulator, David, would be your provincial regulator, in terms of where you're incorporated, or really your main company where it's going public. So typically here in Ontario, it would be the OSC, so the Ontario Securities Commission. And so that would sort of be your primary regulator, right? At the end of the day, they are the ones that would do continuous reviews of your financial statements. So they could pick your financial statements at random at any time, and all your filings, and basically review them, your financials, your MD&A, your press releases, and basically review them and say, hey, we saw this is not in line with the standard.
Right.
And they will go into press releases quite frequently. We see comment letters all the time saying, hey, on the press release, you said this, you're not allowed to say this. This is too prospective in nature, and you didn't have the support to say this, or basically quote specific rules in the Securities Act, right? They're there to do their job. They're there to protect the investors, and they do really review all of your information. And if you don't do the right thing, they can give you a really hard time, right? And so that would be your primary regulator, would be, your provincial regulator, so OSC, or if you're in British Columbia, BCSC. Alberta has its own exchange, so, commission. So every province has their own commission. So that would be, I would say, your primary one. I would say one that you would also have to consider as well is the exchange itself, like the Toronto Stock Exchange would have some regulation as well that you need to make sure that you're covering. So Toronto Stock Exchange, the CSE, etc. But I would still say your real primary one would be like the OSC and BCSC and all that. So that would be your primary ones. The auditors also have their own regulators, which may not be relevant for the CEO and CFO directly, but you will feel their presence through the work that the auditors are doing. So in Canada, CPAB is the one who regulates the audit firms, and ultimately, kind of the bearer of audit quality throughout Canada. So a lot of if they push out new standards, then the CFO will really feel that during their audit, right, as well. So they're not your direct regulator, but a lot of what they do, you will feel through your audit.
And would you say that companies, once they're public and once they know the rules and are able to stay within those lanes, like what do you tend to see pop up as ongoing challenges that they're facing? Reporting issuers. Is it staying current on developments and changes, or is it once they're there and they've got a routine, you tend to see things pretty much steady? I presume when they take on a transaction like an M&A and then the accounting gets more complex, that would be a significant need. Is that the main one?
Yeah. So David, what I would say here is, what was the reason for a lot of these companies to go public, right? Was to grow, right? They didn't just go public to just stay stagnant. So a lot of times, as you mentioned, they're doing a lot of M&A. So the M&A comes with a lot of complex accounting. A lot of times when you're doing M&A, who are you buying? You're buying another private company. So then those guys need to kind of get up to your standard as well, right? So I would say M&A for sure, very complex from an accounting perspective, integrating them, controls, and then raising capital, right? Usually what we're used to is in the venture space, they're not cash flow positive yet. They're in this heavy growth mode, which means they need to continue to raise money. And the raising of money, again, like I mentioned before, there's a lot of creative ways to raise money. And if your method of raising money is complicated, then it comes with complicated accounting as well, which I'm sure that's when you were alluding to like some of the statements not being readable, I feel it's really in some of these equity raises that end up being a liability from an accounting perspective. And these are the things that are a little bit, I guess, strange for non-IFRS users to understand. But I would say M&A, raising money, and then really when their business takes off, they're probably generating a lot of revenue, so making sure that they've got the right systems around that. So, unfortunately, the fun never really ends for a venture company until they get to that steady state. But, that takes multiple years to really get to that point where you're really steady state. Most of my clients are doing many acquisitions a year, so it's very common.
We occasionally hear of going back private, a company that's already gone public and then goes private. And does that happen on the venture space at all? And where do you see that happen? How often does that happen?
I have had some clients and transactions that have, after a while, gone back to private. I actually haven't seen it as much on the venture space, more on, they've become larger now, and then private equity comes in and and buys them out. It becomes a strong business, a good business. So I've normally seen it once they get to the more senior exchange and they get to a point where they're cash flow positive, they're generating good revenue, good EBITDA, then they get some takes from private equity and all that. So I haven't seen it as much on the pure venture side, but I'm sure it happens as well.
And then there's the other way they can go, which is not make it, and venture is venture for a reason. What does that tend to look like? Because you kind of see a lot of these companies that, like, the market caps are just like they're at a penny a share. A lot of companies went through cease trade orders. I don't know if that is indicative of a problem with the business or something else, like getting audits done. And give me a sense of what's happening at that, where those challenges lie, and what leads to when a company's not working. What does that tend to look like? Do they just sit there dormant for a while? Obviously there's regulations and rules around who can stay listed versus not. Give a little bit of color on that, please.
Yeah. So I guess David, one of the stats someone gave me before was they were looking at RTOs and they were saying, hey, if you look at RTOs, they have a much higher failure rate, like long term, than a traditional go public, right? I don't know the exact stat. And so they kind of asked, hey, does that mean RTOs are not a good way to go public? And my response to that was, well, it's kind of cherry picking the information, because if you look at the companies that do RTOs, they are venture companies normally, right? And again, very common in Canada on, the CSE, TSXV, etc. By definition, a lot of these venture companies are just, they're riskier in nature, right? And so some of them really take off and some of them don't. That's just the name of the game, right? It's a very volatile space. Again, high risk, high reward. But a lot of them don't work out just because, hey, the business model doesn't end up being feasible, doesn't work out like it was supposed to. But I think that's just the name of the game of being in the venture space, right? And that would be true for any high growth company. A lot of companies, they don't necessarily stay in the venture space for long. Either they really take off, they get acquired, or like you said, things don't go well and they, have to almost cease to be a public company. One common thing we do see is to give some return back to investors. Let's say if things are really not working out, the business is becoming defunct, that company may actually just become a shell company and then eventually find another target that's private and perhaps a completely different industry, and then go public through another RTO, right? So that's actually quite common for companies that become defunct. I would say if they have clean records and they're continuing to just kind of stick around and meet the public company requirements, they could be a target or a shell for a future transaction as well. So that's a way that, if things didn't go really well, you could still salvage some value for your investors and give them something with a completely new opportunity.
Good. So you don't have to have wasted the effort of getting onto the exchange. So we talk a bit about the anatomy of, a transaction. We've gone a little bit into the RTO, but if you can walk through a process, but almost beforehand when a company's going to raise capital, because a lot of times they're raising that money, before they list or concurrent with the listing. Yes. Give us a little bit of a walkthrough on that.
Yeah, so I think, David, a lot of the times, let's say if you got the operating company, so that operating company is probably doing raises as well. But what's often like a powerful strategy is before the operating company really tries to make those raises, they target the shell company as well. So then they come as a package and be like, hey, we're a package. We've signed an LOI. We're not public yet. However, we have an intention to go public. And with that in mind, as part of that go public, concurrently, we want to do a raise. So coming as like a package is sometimes a little bit stronger because you've got a game plan and you're saying, hey, come represent us. We've got a clear game plan to go public. Can you help us through that process? So often, an LOI will be signed. And like you said, David, it's very common for when I would say almost all the time when our clients are going public, they will do a concurrent raise at that same time. But that was sort of planned some time ago, right? And they're like, as soon as this transaction closes, the money comes in. And like I said, that can take 6 months to a year. The problem is, like, if you're too slow on that process, right? If you come and say, hey, our intention is to go public, and someone is committing to potentially raise money for you and you take double the amount of time that you were supposed to, that could really sour the deal. And it's like, well, we don't want to invest in you guys anymore, which comes back to the point of why there's a lot of pressure on our side, on the accounting side, to get everything done very quickly, because you just lose that window of opportunity of that raise sometimes. And that's why being prepared can help you not miss that opportunity when it does come. As you know, things change very quickly. Like, capital could be very available one day, but 1 or 2 months later, it could be gone, right? So when that opportunity and you approach the bankers and you start that process, you want to go as quickly as possible because, you don't want to sour the deal or lose potential raising opportunity.
When those folks are giving you money, investing in your business on the way to go public, and you're still venture, just in my personal experience, like there weren't a lot of questions about the business. It was really much more about a term sheet and an economic opportunity for us to list. It almost felt like they were betting more on our ability to get listed than it was on our ability to build a real business.
Yeah.
Talk a little bit about that. Is it, and in relation to that, the sort of normal course of what lockups look like for shareholders today, what has to happen when they go public? Hopefully that you can combine that into one response. But they're all sort of connected in that, you're raising money. People, when you get public, have a plan to make money. Existing shareholders are there. They've been on the ride maybe for a long time. They want an opportunity to sell
Mhm.
potentially, but then they've got lockups. So there's a whole dynamic there. Give us a bit about that.
Yeah, so I guess David, I guess firstly, and I'm sure you would know this kind of even better than me, is really, especially on the venture side, a lot of it is about the future, right? It's like, hey, what could this company do? And that's where I say a lot of the times people don't always care about the historical financial statements as much as accountants would love to think that. The reality is it's so future oriented. Hey, if we raise money, what could we do with that money? And what could we purchase? How could we scale the business? Which is why that kind of act of being able to go public and raise that money becomes so important. Because if you don't do that, then all of these lofty plans, it's not possible to do any of them, right? So I think it's in that venture space that everything is sort of at some point contingent on the transaction closing, because then the whole trajectory of the business completely changes if that doesn't happen. So I think in my mind, that's why it becomes super important. I'm not an expert on the exact lockups because it does really differ based off of the way you go public. Like I would say, for example, the TSX venture has these companies called capital pool companies that are just designed to be shells, and which are a great way to do an RTO. But often the restrictions there in terms of the shareholders, they need to hold the shares longer. There's longer lockup periods.
Right,
So
right.
often at the end of the day, whoever that shell company is, there will be lockup restrictions where they can't sell the shares right away. And it makes sense. Like you don't want to go public and then everyone to dump your shares right away, right? So there are certain lockup requirements that don't allow people to, especially in the shell company or certain founders, to dump those shares right away. Again, it really depends on the structure, and those conditions can change. But really, those lockup or those restriction periods are there to protect the investors and make sure that things kind of go steady for a while. That's just a bad situation where everyone dumps this stock day two, and it's not good for anyone.
For sure. When you mentioned the capital pool companies or CPCs, is that specific to TSX? And
TSX
you
Venture
and
specifically.
those are effectively the shell companies on the TSX venture, but they're not. There could be a separate type of shell, or like, are there other types, or is CPC the only way to do an RTO on the venture?
No, even on the TSX Venture, you would have CPCs, and then you would have basically shell companies that don't qualify as CPCs, right? There's a lot of rules and regulations on what you need to have a CPC. And like I mentioned before, David, like it could be a former defunct company that's just a shell. It's not a CPC, but it's still a shell because there's not much business activity. So
But
uh,
which is the preference if you're a company trying to go public? Would it be through a
I
CPC,
think
or would it be
like the
through?
good thing about a CPC is that it is very clean, like in a
Yeah,
sense that literally that company was designed to go public, right? Or
right,
to take someone public. So
right.
you don't have all these historical liabilities. You've got the directors in place who are literally again designed to make the vehicle go public. I do know from a liquidity perspective, sometimes again the holding and the restriction periods are a little bit more. So certain people might not prefer having those bigger restrictions. So I'm not an expert in it, but I think the liquidity is not as good. But from an actual like cleanliness perspective, is very clean, right? It's very easy to look at a CPC. It was designed for that. So there's pros and cons, but we do see that as a very very common way for companies to go public on the TSX venture.
Got it. Yeah, I'm probably pushing you into sort of legal territory or some of the
Exactly.
other
I'm
folks.
not a lawyer. I'm just, more, again, we do
Yeah,
deal with a lot of these things just
right,
because
right.
that's kind of our, we see it all the time, but at a
Yeah,
certain point, it becomes very legal in nature. So,
yeah, yeah. So, just one thing I wanted to ask was around industries, and what that tends to look like for you. What kind of companies are you generally focused on? I'm sure resources is one category. Uh, Emerging industries. Give me a little bit of a flavor of the types of industries you play in.
Yeah, so David, I would say like the big thing is emerging. So whatever is emerging, whatever is like new on the block, like we'll be there, right? And that's kind of our name of the game. And that's the exciting thing is that we never know what's going to be new. So but we know we'll be there. So if I kind of look at sort of our client mix, mining and resources is very predominant, like you mentioned, because that's just very popular on the TSX Venture, CSC, etc. But then if you look at in like 2017, 2018, there was like 50 to 100 cannabis companies that went public, right? So they were many of our clients. So cannabis was very big back then. Gaming started to become very big around the COVID time. Psychedelics became big for a while, but then it kind of went down, right? So whatever's really emerging, a lot of tech deals, we're obviously seeing a lot more AI plays now. A lot of crypto plays kind of came in the early like 2017, 2018, but whatever's kind of new and emerging, like we're not really focused on one industry. We're pretty industry agnostic here at MNP, but at the end of the day, whatever's kind of new and emerging, we're first on the scene.
I can imagine the complexity on the accounting side gets quite interesting. Um, like when you think about crypto, just different types of business models where there may not be a really well defined, uh, way to look at the accounting. Do you find that to be a real challenge and a real area where you're helping these companies navigate kind of the unknown and you're all figuring it out at the same time?
Yeah, so we're not actually auditing crypto companies right now. That's just
Yeah.
kind of the position of the firm. But generally, the interesting thing is when we're into these emerging industries, like a lot of the times things aren't figured out at first, which is really exciting from a CFO accounting. You're kind of like paving the way for companies, and so you've got these standard set of accounting rules, and you have to see, hey, is this really novel or has this been done before, right? So for example, if you look at like a crypto, like back in like 2017, 2018, there was no real accounting guidance on it, but now SEC and so forth have put out a lot of guidance along the way. But in the early days, you use the accounting standards, you make a position, you support the position, and you go from there, right? But it's very exciting to be in those kind of early stage industries where it hasn't been done before, and you sort of figure out the accounting on the way. Maybe not exciting for everyone, but I guess for accountants,
Well,
it's exciting.
on that note, I talk to, and I'm sure you do as well, a lot of folks that are coming out of school thinking about the CPA path. I don't feel as well, positioned to speak on all these paths now because it just looks so different than when we started out, and it was just one path, which was starting an audit. Um, so I guess there's sort of a couple of angles to this that I'd love to cover. One, how do you advise folks in that stage around how to think about a career as a CPA? And you've certainly taken it in a really interesting place. It's not just a traditional audit partner, and you're doing this, advisory work, and you've switched firms, and as you said, just much more involved with businesses in a different way. So a bit about your path, and what are you telling folks that are coming into this world and considering a career as a CPA?
Yeah, it's a great question, David. And I've been fortunate enough to actually teach at universities as well. So I get this question a lot. It's like, hey, what should be my first kind of out of school job and all that. And like you said, David, there's so many paths to being a CPA now. It's a great time. And I actually think, to be honest, it's probably not been a better time to be a CPA coming out of school or going into accounting. The reality is, if you actually look at the numbers, accounting enrollments have gone down quite a bit over the last few years. Maybe it's not as sexy as maybe it once was, or maybe it was never never that way. But like the enrollments aren't as high. But from what I've seen, the demand has continued. So supply of accountants is slowly going down. And in my opinion, demand is going up, right? So that's a recipe for, hey, if you do come out, you'll do well. And of course, I've been told since I was in university or even in high school, say, hey, accountants will become obsolete in a few years with technology. And you hear the same thing now with AI. I don't think that's going to happen. At the end of the day, the AI will help augment what we do, but it's not going to be replacing accountants anytime soon, in my opinion. So coming out of university, I'm still a big proponent of the firms. I know there's a lot of different routes. And even if that's not and I totally understand that's not all people's ambitions long term. But what the best part about a firm is when you're coming out of school is that you are the revenue generator. You are in a job where your team is actually generating the top line revenue. And I think that's a really good place to start your career because it does put a lot more great experiences on you. And being at a firm, you get to basically tackle different clients every day. And when you're coming out of school, you don't know what industry you want to work in. You don't know what you want to do. So by being in a firm, you just get exposure to many industries, many different type of companies. And then you can decide, hey, what do I like and where do I want to go? So even though there are many different paths, and I'm still very supportive of that, I still really think the firms provide a very good outlet because at the end of the day, you're dealing with clients directly. You have many different type of clients. You're dealing with different industries. You're working with a lot of smart people that are in your profession as well. And at the end of the day, you get a lot of responsibility very early, and you can really kind of uptick your career very quickly. So I still think it's a really, really good path, but some people really don't want to go there and want to go elsewhere. That works too. That's a good thing. There's options.
That's the best recruitment pitch I've heard. I hope they've got you out on the circuit at the schools. So not just teaching, but
yeah.
But
and I was actually, honestly, I was giving that advice. There was a time where I left the firm. I was still giving that advice, even when I wasn't affiliated with the firm. Like I was just like, hey, I actually think this is still the best outlet, and you choose where you want to go once you get your CPA. But those fundamental first 2-3 years, you get a lot of experience just dealing with different clients, right?
And I would add to that, the fact that you have, first of all, I just love that point around you are the product, you are the service within an accounting firm, versus you're in the back office of an organization that you may really not get exposure to the business itself. And so the firms know how to train you. And then you've also got peers around you that are all in the same year, same cohort, varying sizes of different firms and offices. But the sort of professional development and growth you get from other people around you. And then once you go work for a company, you could be in a team of 1, 2, 3, 4, maybe sort of limited in the exposure. So I think not just the client side, but internally the people you're working with, there's a lot to be said for that. So I love that advice. And it doesn't mean you have to stick to audit.
No, and that's what I didn't give the word audit in my answer, right? I just said somewhere where it's client service.
Yeah.
And at the end of the day, a lot of the time accountants are cost centers. You like at the beginning of your career, I think you want to be a revenue or a profit center of the business and not a cost center. Eventually, you might want to go more in the back office, but at the first part of your career, it's very valuable being in client service, right? And again, whatever that is, from audit to advisory to tax to valuation to controls and to risk management, doesn't really matter as long as you're facing clients and have a lot of smart peers around you. And great thing about MNP, even today, like we've got over 1,200 partners. If I don't know the answer, I pick up the phone, I call someone at the firm, and we have a conversation about it. And I don't, if I was outside, I'd have to pay for that advice, right? And I'm just learning. It's great.
Yeah, amazing. Hey, on that note, amazing information that you've shared today. Tons of value. Hope you'll do this again. Really appreciate it, Bijan. Thanks for being here.
Great. Thanks so much for having me, David.